If you've ever tried to mix income investing with exposure to fast-growing tech stocks, you've probably noticed those two goals don't usually go hand in hand. But there's one fund that claims to do both. It's called the BlackRock Science and Technology Trust, or BST. On paper, it's a fascinating structure. Part tech growth portfolio, part income-generating machine. It's managed by BlackRock, one of the biggest players in global finance, and it's gained a lot of attention for offering monthly cash payouts from a sector that usually reinvests every dime. So, what is this thing really? In this video, we're going to break it down from every angle. What BST actually is and how it works, how it uses options to generate income, what's inside the portfolio, where it fits in a real-world portfolio strategy, and the real risks behind the shiny numbers. I don't work for BlackRock. This isn't sponsored, and I'm not here to sell you on anything. This is a deep dive explainer for anyone who wants to understand how funds like BST operate, whether you're a long-term investor, a curious beginner, or just trying to decode the alphabet soup of modern investing. Let's get into it. BST is a closed-end fund. That already sets it apart from the ETFs and mutual funds most people are familiar with. In a closed-end fund, there's no daily creation or redemption of shares. Instead, the fund launches with a fixed amount of capital and trades on the stock exchange like a regular stock. This means the price of the fund can, and often does, diverge from its net asset value, or NAV. If the market gets excited, it may trade at a premium. If investors get cold feet, it can trade at a discount. And that opens up both opportunities and risks. Unlike an ETF, which typically mirrors an index passively, a closed-end fund like BST is actively managed. This means a team of professionals is constantly analyzing markets, reviewing company fundamentals, and making real-time decisions about what to hold, what to trim, and how much exposure to maintain in various subsectors. That active element can be a double-edged sword. It allows for more tailored risk management, especially during turbulent markets, but it also introduces management fees and the potential for underperformance compared to a benchmark index. Investors need to weigh whether the added flexibility justifies the cost. Historically, BST has taken advantage of market themes like the rapid digitization of businesses, adoption of cloud services, AI advancements, and medical technology innovation. When the pandemic accelerated tech usage globally, BST's positions in data centers, remote work platforms, and chip makers helped drive returns. Even as interest rates began to rise in 2022, the fund continued to rely on active sector rotation to adapt. It's positioned to deliver both growth and income. The growth comes from investing in tech and science-related companies, firms like Microsoft, Apple, Nvidia, Meta, and other big players in cloud computing, semiconductors, AI, and biotech. These are companies typically known for reinvesting in their own growth, not sharing it through dividends. The science and technology theme is broad. It includes not only consumer tech, but also enterprise software, chip makers, biotech innovations, healthcare technologies, automation, robotics, and more. The goal is to ride the wave of global digital transformation, and not just through the giants. BST also includes mid-cap firms that are innovating behind the scenes, often in emerging fields. So where does the income come from? That's where the fund's strategy gets interesting. BST uses a method called covered call writing. This involves holding shares of a stock and then selling call options on those shares. The fund collects a premium from selling the option, essentially renting out the upside of the stock in exchange for cash. That cash becomes income that can be paid out to shareholders. This strategy is particularly appealing when markets are volatile or moving sideways. It lets the fund generate cash flow even when the underlying stocks aren't surging. However, it also caps the upside if those stocks rally sharply, since the fund may have to sell them at a preset price. Covered call writing is a form of risk-adjusted income generation. It doesn't eliminate risk, far from it, but it transforms some of the portfolio's capital appreciation potential into immediate, realized cash flow. This makes it an attractive strategy for investors who prioritize consistency over maximum upside. It's also worth mentioning that covered calls tend to perform better in range-bound markets. When the S&P or Nasdaq isn't making huge upward moves, options premiums collected from selling calls provide meaningful returns. This creates a smoother income stream even in uncertain times. So what's inside BST? As of the most recent data, it holds around 90 to 120 positions. It's tech-heavy, yes, but also includes names from the healthcare and industrial innovation space. Think of companies in AI, big data, medical devices, cybersecurity, and next-gen hardware. You'll find high-conviction holdings in firms developing software for autonomous driving, gene editing technology, and advanced processors. You may even find lesser-known innovators like Illumina in genomics or ServiceNow in workflow automation. This mix helps capture both growth potential and portfolio resilience. It also includes some international exposure. BST isn't limited to the US, which adds a layer of diversification, though it still leans heavily toward American companies. That said, exposure to overseas innovation hubs like Israel, South Korea, or the Netherlands helps balance the US-centric nature of most tech funds. The fund pays distributions monthly. As of 2025, the yield is around 8%. But this can fluctuate depending on market conditions, premiums collected from option sales, and the performance of the underlying holdings. Some of that distribution may include return of capital, which isn't necessarily a red flag, but does require understanding from a tax and sustainability standpoint. Who uses BST? You'll often find two types of investors here. First, retirees or income-focused investors who want cash flow but still want exposure to growth sectors like tech. Second, younger investors who are okay with the volatility and reinvest the monthly payouts to accelerate compounding. Some use BST as a complement to growth ETFs like QQQ or XLK. Others use it as part of a dividend income ladder. It can also act as a hedge against inflation, assuming the companies it invests in continue to deliver pricing power and productivity-enhancing innovation. A few portfolio examples. One investor might pair BST with municipal bonds and REITs for a high-income diversified sleeve. Another might use it alongside growth funds, adding income to a total return strategy. But BST isn't for everyone. It has real risks. If tech underperforms, the fund takes a hit. If market volatility dries up, the call premiums shrink. If the fund is forced to sell high-performing stocks because of the call strategy, it can miss out on long-term gains. Also, remember that this is an actively managed fund. That means it comes with management fees. As of recent filings, the expense ratio is around 1%, which is higher than passive ETFs, but reasonable for a CEF with this level of complexity. There's also liquidity to consider. Because BST is a closed-end fund, it doesn't always trade in high volume. That means price swings can be more dramatic than with ETFs, especially during broader market stress or low-volume trading sessions. Another overlooked aspect: tax implications. While BST can be held in a tax-advantaged account, holding it in a taxable account may require closer scrutiny, especially when return of capital is involved. Investors should always check the annual 19A notices and consult tax professionals. So how do you evaluate whether BST fits into your portfolio? Start with your goals. If you're looking for monthly income and can handle equity-like volatility, BST might fit. But if you're more interested in aggressive growth or prefer the simplicity of index funds, there are probably better options. It's also worth looking at where BST is trading relative to its NAV. Buying at a discount can boost your long-term returns. Buying at a premium can do the opposite. Some investors set alerts or use screeners to track discount windows in funds like BST. It's a common strategy among CEF enthusiasts. Final thoughts. BST is not a gimmick. It's not a magic bullet. But it is a thoughtfully designed tool for investors who understand what they're buying. It combines high-growth exposure with income, wrapped in an actively managed structure that uses options to do what most tech funds can't: pay monthly. As innovation continues to reshape our world, from AI to quantum computing, from biotech to clean energy, funds like BST offer an interesting lens on the future of investing. The key is to approach it with clarity. Know what you're getting, understand how it fits your strategy, and monitor it over time. Thanks for watching. If you've got questions or want to see this compared to something like QYLD or BSTZ, drop a comment below. And if you like content that explains investing without hype, subscribe and stick around. We've got more deep dives coming soon.